In the richest state in America, California, something unusual is unfolding, not inside Silicon Valley boardrooms and not on Wall Street, but in parking lots and along quiet residential streets. Across cities like Los Angeles, San Francisco, and San Jose, thousands of people are now living in RVs, vans, and converted buses, forming mobile neighborhoods born not of lifestyle choice, but financial necessity. As median rents climbed toward $2,000 to $3,000 per month and home prices drifted further out of reach, wage growth failed to keep pace. Zoning restrictions limited density, environmental reviews slowed development, higher interest rates pushed mortgage payments upward, and institutional investors absorbed large volumes of entry-level housing. The result was not a sudden collapse, but a slow pressure build, a structural housing shortage years in the making. And when shelter becomes scarce in a market economy, scarcity itself becomes monetizable. That is where the Vanlords enter. A Vanlord is not a traditional landlord with deeds and long-term leases. Instead, they purchase used RVs, sometimes for $20,000 to $30,000, park them in semi-regulated areas or rented lots, and lease them out for $800 to $1,500 per month. The asset depreciates, the land is often not owned, infrastructure is minimal. Yet the cash flow can be steady, and in some cases, the initial investment can be recovered within just a few years. Compared to purchasing a $700,000 home burdened by property taxes, insurance, mortgage interest, and strict regulation, the capital efficiency looks radically different. This is micro-landlord capitalism operating in a gray zone, part necessity, part opportunity. It has been fueled by several macroeconomic forces: post-pandemic remote work that normalized vehicle living, widening income inequality between high-earning tech workers and low-wage service employees, rising borrowing costs that slowed new construction, and a decade of institutional capital concentrating ownership of starter homes. When fixed housing supply collides with flexible mobile assets, a parallel market forms, and substitute housing inevitably produces substitute landlords. What we are witnessing is the emergence of a shadow housing system. Informal, lightly regulated, and expanding because the formal system cannot scale fast enough. Some cities attempt RV parking bans, others experiment with safe parking programs, yet enforcement is costly and displacement rarely eliminates demand. The deeper imbalance remains. Housing supply lags population growth, construction costs remain elevated, land is scarce, and political resistance constrains high-density reform. History shows that when official housing markets fail to meet demand, whether in post-war shortages, rent-controlled cities, or emerging market settlements, informal systems fill the gap. California's RV economy is not simply about vehicles. It is about capital allocation under stress. It reveals what happens when land becomes unaffordable, wages stagnate, interest rates rise, and supply cannot respond. Housing is the foundation of financial stability. When that foundation cracks, new systems emerge, sometimes innovative, sometimes exploitative, often both. The rise of Vanlords may not be permanent, but it signals a larger question for high-cost economies. Can the formal housing system reform quickly enough to outcompete the shadow market, or has mobility become the new lower tier of the American housing ladder?